In today's fast-paced business world, innovation and finance have become inextricably linked. As technology advances at an unprecedented rate, companies must not only innovate, but also master the intricate dance of funding these innovations. The landscape of corporate finance has transformed dramatically, creating new pathways for businesses to turn groundbreaking ideas into market-ready solutions. In this ever-evolving ecosystem, understanding the relationship between innovation and financial strategies has become crucial for corporate success. Venture capital and startup financing. The story of modern innovation often begins with venture capital, the driving force behind many of today's technological giants. Companies like SpaceX, Uber, and Airbnb were all built on the foundation of venture capital funding. These investors don't just provide capital, they bring expertise, networks, and strategic guidance to the table. The process begins with seed funding, where early-stage startups receive initial capital to transform their ideas into viable products. As these companies grow, they progress through Series A, B, and C funding rounds, each bringing larger investments and higher valuations. Today's venture capital firms are increasingly focused on scalable technology solutions, looking for the next unicorn that could disrupt traditional industries. But it's not just about the money. Modern venture capitalists are deeply involved in their portfolio companies, often taking board seats and actively participating in strategic decisions. They help startups navigate challenges from product development to market entry strategies, becoming true partners in the journey of innovation. This hands-on approach has revolutionized how startups grow and scale in today's competitive marketplace, intellectual property and its valuation. In the knowledge economy, intellectual property has become one of the most valuable assets a company can possess. Patents, trademarks, and trade secrets form the foundation of competitive advantage for many innovative companies. Take pharmaceutical companies, where a single patent can be worth billions of dollars, or technology firms, where software patents protect crucial innovations. Valuing intellectual property requires sophisticated methods that consider market potential, development costs, and future revenue streams. Companies use approaches like the income method, market method, and cost method to determine the worth of their intellectual assets. The challenge lies in quantifying the potential of something that might not yet have a market. Furthermore, intellectual property isn't static. Its value can appreciate or depreciate based on market conditions, technological advances, and competitive developments. Companies must constantly monitor and protect their IP portfolio, making strategic decisions about which assets to maintain, license, or sell. This dynamic nature of IP valuation requires continuous assessment and adjustment of strategies to maximize value creation. Corporate incubators and accelerators. Major corporations have recognized that innovation often comes from outside their walls. Companies like Google, Microsoft, and Intel have established their own incubators and accelerators to tap into the startup ecosystem. These programs provide resources, mentorship, and often funding to promising startups, creating a new model for corporate innovation. Corporate incubators typically focus on early-stage companies, providing office space, basic infrastructure, and mentoring. Accelerators, on the other hand, run intensive programs lasting several months, aimed at rapidly scaling startups through focused mentorship and resources. This approach has revolutionized how large corporations interact with the startup ecosystem. The benefits flow both ways. Startups gain access to corporate resources, expertise, and potential customers, while corporations get early access to innovative technologies and potential acquisition targets. This symbiotic relationship has become a crucial part of corporate innovation strategy in the modern business landscape. The success stories emerging from these programs demonstrate their effectiveness in bridging the gap between corporate resources and startup agility. Partnerships with academia and research institutions. The bridge between academic research and commercial innovation has never been more important. Companies are increasingly partnering with universities and research institutions to access cutting-edge research and talent. These partnerships take various forms, from sponsored research programs to joint ventures and technology transfer agreements. Universities benefit from corporate funding and real-world applications for their research, while companies gain access to specialized knowledge and potential breakthrough innovations. Many groundbreaking technologies, from genetic engineering to artificial intelligence algorithms, have emerged from such partnerships, demonstrating the power of academic-corporate collaboration. These collaborations often extend beyond research. Companies provide internship programs, sponsor academic chairs, and participate in curriculum development. This creates a pipeline of talent and ensures that academic research remains relevant to industry needs, fostering a continuous cycle of innovation. The long-term impact of these partnerships can be seen in the development of new industries and the transformation of existing ones. The role of government grants and incentives. Government support plays a crucial role in fostering innovation, particularly in high-risk, high-reward areas where private investment might be hesitant. Programs like SBIR, Small Business Innovation Research, in the United States provide crucial early-stage funding for innovative small businesses, filling gaps in the private funding ecosystem. Tax incentives for research and development encourage companies to invest in innovation. Many countries offer R&D tax credits, patent boxes, and other fiscal incentives to promote corporate innovation. These programs have been particularly effective in supporting developments in areas like clean energy, biotechnology, and advanced manufacturing. Beyond direct funding, governments also create innovation ecosystems through policies and infrastructure. Science parks, innovation clusters, and regulatory sandboxes provide environments where new ideas can flourish. The success of regions like Silicon Valley demonstrates how government support can catalyze innovation and economic growth, creating lasting impact on the global economy. Governments worldwide support strategic industries via grants. Initiatives focus on emerging technologies like AI, quantum computing, and renewable energy. Programs such as the European Union's Horizon Europe provide funding for research and innovation, while countries like Japan and South Korea offer specialized grants for semiconductor development and robotics. These interventions bridge the valley of death and accelerate innovation in critical sectors through public-private partnerships. The future of innovation finance. As we look ahead, the intersection of innovation and finance continues to evolve. New funding models are emerging, such as tokenization of assets and blockchain-based financing. The rise of impact investing is pushing companies to consider both financial returns and social benefits. Artificial intelligence and machine learning are transforming how we evaluate investment opportunities and manage innovation portfolios. In this complex ecosystem of innovation finance, success depends on the ability to orchestrate multiple funding sources and support mechanisms, from venture capital to government grants, from corporate incubators to academic partnerships. Each element plays a vital role in turning innovative ideas into market-ready solutions. As we continue to face global challenges and opportunities, this sophisticated financial infrastructure will remain crucial in driving the next wave of technological and business innovation.